Hello and a very warm welcome to the 17th episode of Money Side Up. It's great to be back recording the next episode. We've got a bit of a different episode today, but we'll tell you more about that and what's to come shortly. But thank you very much for joining us. Money Side Up is the money podcast, all things personal finance for Australians at home and all over the world. So thank you for joining. I'm Jared Brown, Senior Financial Advisor here in Singapore, and joining us today are both of our co-hosts, Senior Advisor Joel Kerin in Perth and Senior Advisor William Cant in New South Wales. G'day, guys.
Hey, Jared. And I think it's an excellent preface you've made there that today's episode will be a little bit different. Normally we interview an expert on the podcast, but Joel and I are the experts today in our respective fields. So very keen to get into this one.
Plenty to cover. Well, look, before we dive in, Joel, do you want to cover off the disclaimer, keep our legal team happy?
Absolutely. So what's a podcast or a presentation without a legal disclaimer, right? So everything we discuss in this podcast and in any of our material is what we would consider general in nature. It's purely for your entertainment purposes only. Of course, if you want personal financial advice, it's really important that you reach out to one of us. We're happy to provide you with personal financial advice and make sure that anything that we discuss is 100% relevant to your individual circumstances.
Brilliant. All right. Well, now we've got that out of the way. Let's dive in. So it is early May, mid-May at the time of recording this. So end of financial year is just around the corner. We always like to talk about this before we hit June because we know that far too many people leave it until the absolute last minute, and neither the super funds or the Australian Tax Office is terribly interested in extending deadlines. So more on that to come. But guys, I thought it'd be good to start. We've got the next RBA meeting next week. And I think rate forecasts, I think it'd be fair to say, have changed a little bit since the beginning of this year, particularly since some of Trump's announcements. But look, what are we thinking? What's the RBA going to do? We're going to get a cut? We're going to hold? Joel, what do you think?
I think a cut's coming. At least, let's just pull out the crystal ball for a second there. With inflation data obviously slowing and a lot of, more political events that have happened in the market, I sort of forecast that at least 25 bips are coming. So much so that I think there was one or two banks in Australia that said it could even be as high as a double, so up to 50 basis points. So this is, very welcome news for Aussies around the country or expats for that matter, that have a mortgage. So, 0.5% off coming off the mortgage, that's going to breathe a big sigh of relief to mortgage and debt holders in the country. So I suppose it is going to be a little bit all eyes on the RBA as they go into their meeting next week and see, what their forecast really is for those inflation figures and that data and how aggressive they're going to be with those cuts. But ultimately, I think I'm pretty confident that we'll see another cut, whether it'll be a single 25 bip or a 50 bip. I suppose time will tell, but I'm opening that forum if anyone has an alternative view.
No, my fingers are crossed for 50 basis points as well. As a mortgage holder, I'm waiting for that rate to come down. But it's interesting when we look at, where the forecasts of the Australian rates were going to go for the next 2 odd years, say 3 months ago, to what they're forecasting now. It's vastly different. I mean, I saw an article the other day that was stating NAB were believing there were going to be 5 cuts before February next year, and the other 3 major banks all thinking there was going to be about 3 cuts. So that's really, ramped up, this cycle that we're in now, as opposed to start of the year even, the forecasts were completely different. So it just really shows you how quickly things can change as well.
Absolutely. And I mean, I think, look, it's important to note that the banks are notoriously bad at forecasting most things. So do take all of this with a pinch of salt, whichever bank you listen to. Generally, they're pretty accurate in terms of direction. So, and I think we can all agree that rates are going down. And hey, I think all of us on this call hold some form of debt. So I think we'd all be pretty glad to see a bit of a rate cut. And hopefully, at least for some of us and some of those listening, if that could see the Aussie dollar weaken a little further, even better for some of us, probably not so much for others who might be trying to leave Australia's shores. We did also see the employment data out this morning, so 89,000 new jobs. Unemployment remained at 4.1%. So I don't think, really too many major surprises there in terms of, what most analysts were expecting, what the RBA was looking for. Full employment is not what it was, back in our sort of economics studies in high school and university many, many years ago, where, full employment was kind of in those low fives. I think that's quite a different number now, particularly as, the ability to work from home, work remotely, work online, work part-time, starts to sort of change and alter some of that data. So look, not to avoid creating contention on the podcast, but look, I think we'll get a rate cut as well. I think we're all kind of in agreement there, hoping for 50, but I think we'll get 25. And the beauty of this is this podcast will be released just after the announcement. So there we go. Hopefully no surprises between now and then. Guys, I guess the other big announcement, not necessarily so much on a global level, but certainly impacting those at home in Australia, was the election. Perhaps a bit more of a landslide than in Australia's terms, not in Singapore's terms of what a landslide election looks like. But I guess from your perspective, what does it mean for markets, for people in Australia in terms of finances, outlook? Will, do you want to kick us off?
Yeah, well, there's a few points there to call out. So first and foremost, like you touched on, it was a bit of a landslide, which has really shaken up the Liberal Party here in Australia, who've just gone through a completely new shake-up, a new leader announced just the other week. So definitely, a few things to consider there for potentially what the next election might look like and what their policies are going to be moving forward. But here, with the Labor Party having the win, there's a few things that we're looking at really closely. One of them being the $3 million cap on superannuation, with the tax above that amount being at 30% on unrealised gains. That is a policy they are still pushing forward quite strongly, albeit to a lot of dismay from the public. A lot of people saying, the fact that it's not indexed mean that over time, more and more people are going to be breaching that cap. There was a study done, the average 22-year-old today earning the average income will easily have $3 million in their super by the time they're age 60, which means really this policy, yes, is impacting, I think it was about 80,000 people today with their super balances over 3 mil. But as time goes on with no indexation, that policy is going to impact hundreds of thousands of Australians. So that's one we're really looking closely to see what happens there and what the outcome will be there. Another few things too, that the Labor Party has promised, 20% cut on HEX. It was a big one. I still have a little bit of HEX left, so I'm looking forward to hopefully getting a reduction there. That would be nice, but there's still no concrete legislation on that yet pushing through. However, they did state they wanted to get it done before June 1st, so a bit of a time crunch there, in Parliament. But look, a lot to look out for. The Albanese government's mainly focusing on cost of living here in Australia and any ways that they can relieve that. So it'll be, an interesting couple of months to see, what election promises come to fruition and which ones are, never speaking of again.
Absolutely. Joel, anything to add from your perspective as to what the election might mean?
Not, I suppose, nothing really additional that Will hasn't covered, but I suppose this is probably a really good time for the Labor government to, securing a second term in the country. It's, probably just a good opportunity to allow policy to sort of carry forward and go through. And we'll see a lot more, cemented policy pass through both the the lower and upper house. So what your political views are sort of aside, it'll be really interesting to see how that transpires. Particularly, we've got a full other term of other, probably more politically advanced or contentious leaders as well over this term as well.
Absolutely. Certainly from our perspective, we talk a lot with a lot of our clients around property back in Australia. Whether it's, buying the kids a property, buying the future home when they move back, or it's, just people trying to get into the market and find that investment. And I think both parties were really going to be quite supportive, I guess, or really, put it bluntly, really drive property prices considerably higher. And I think, under the Labor government, we're no doubt going to see that. We're going to see a lot of demand that's brought forward. People will be able to get into the market a lot sooner than they may otherwise have been prepared to. And that, I think, coupled with interest rates coming down. So depending on what happens with unemployment, to keep our economists happy, may kind of dictate what happens there. Of course, time will tell. So look, let's dive into, what we'll call the special part of our episode. This is always a busy time in our world for our Australian expat clients, our Australian resident clients. It's end of financial year. So obviously, between Will, Joel and myself, there's a lot we can cover. We thought we'd break it down today into 4 key areas to hopefully give the community a lot of value, our listeners a lot of value, a lot of information around these areas. They're based on the questions that we face with our clients on a regular basis and the broader Aussie community. So we're going to dive into superannuation, family trusts and other structures. So a few myth busters in there. We've got a sort of special section on Australian expats, but that'll be kind of peppered throughout. And then we'll dive into some, strategies, tools, tricks and tips for Aussie property investors as well. So we'll dive into some case studies, some questions, some general information. We're going to keep this very conversational. So guys, without further delay, let's dive into superannuation. It's end of financial year. We've got 6-7 weeks left of the 24-25 financial year. Make sure I get that right. So look, let's start with the basics. Concessional, non-concessional, what do people need to know? What are the 2 types of super contributions? Let's start with the basics.
Yeah, happy to tackle that one, Jared. I'm a big fan of superannuation, as many of my clients know. It's a great structure for, growing your wealth, albeit it does have, a few cons with it. But when we contribute money to super, there's 2 ways it can go in. A concessional contribution, which is considered a concession for the Australian taxpayer. So that goes in and pays 15% tax. But if you're here in Australia earning income, you'd much rather pay 15% than 32, 39, 47, whatever your marginal tax rate is. So it's a concession to us. The current limit for those is 30 grand a year, but that also includes when your employer puts money in for you as well. The super guarantee rate, which is the rate your employer has to put money in, will be 12% from July 1st. So if you make $100,000 for the year, let's say here in Australia, your employer will legally need to put $12,000 into your super, which means you could put in another $18,000 in yourself and use that as a tax deduction. So we're opting to pay 15% tax as opposed to whatever your marginal tax rate is on that money. So that's the first way money can go into super. The second way then is a non-concessional contribution. As the name suggests, there's no tax concessions for this. The money gets to go into super with no tax implications, so a tax-free contribution, but you cannot use it as a tax deduction or any other tax benefits. Current limit for those is $120,000 a year. Now, we speak with a lot of expats who come to us and say, I want to put some money in my super. What do I do? Which option should I go down? Which path should I go down, I should say, sorry. The option really depends on you and your circumstances. If you have taxable income in Australia, maybe it's better to do a concessional contribution and reduce that taxable income. Potentially you've got no taxable income in Australia, in which case a non-concessional might outweigh that. Maybe you're over certain caps or certain limits that means you can only do one or the other. So there's really a case-by-case basis here. And again, this is one of these areas where we just emphasize, seek some advice on what you should do, because the difference can be, potentially tens of thousands of dollars.
Absolutely. Now, Joel, I think, one of the, areas of super that almost seems deliberately confusing, this whole looking back, looking forward, carry forwards, bring forwards. Walk us through what this means. What do people actually need to know?
Yeah, so that's just in, I suppose, the timing of the contributions themselves. And this can be really advantageous to getting, larger sums of capital into superannuation. The whole purpose of superannuation at its core is, I suppose, to provide a retirement income. And it's extremely tax effective once you meet a condition of release and you transition your accumulation balance into an account-based pension. So ultimately, when we're using bring forwards or concessional carry forwards, we're using a contribution amounts from different years in the current year. So you've got the non-concessional bring forward rule. So the bring forward rule allows you to bring up to 3 years of your non-concessional cap into the current year. So, as I'm sitting here recording this on the 15th of May, 2025, we are rapidly approaching end of financial year. So, I'm doing an example with a client at the moment where we're making a non-concessional contribution of the full cap for the 2025 year. So $120,000 in this financial year. 1st of July is going to roll around and we can bring up to 3 years in one go. And that's 360,000 after the 1st of July. Now that will restrict the eligibility to contribute for another 3 years in non-concessional contributions because you've brought your cap forward into the current year. You've then got the concessional carry forward rule. So this works in the opposite direction. So where Will was talking about claiming tax deductions and having a tax concession, any unused concessional contributions that you didn't use in the previous 5 years, providing you've got a superannuation balance less than 500,000 and you exceed your current concessional cap, it will automatically start using the previous 5 years of unused concessional caps. And you can do that all in 1 year. So now with the current maths, if you've been an expat for many, many years, you haven't made any super contributions at the current financial year, I believe from memory, good maths is about $162,500 that you could potentially add to superannuation if you had a taxable income event in Australia or, just income in general that you could potentially claim a tax deduction. So these can be really advantageous ways to maximize your superannuation balance in the lead up to retirement.
And even just further on that, Joel, I think you touched on such an important point. It's all about the timing. So that 162, let's say you sold the property on April 1st. That 162,000 you can put into super potentially could save you $52,000 in taxes. So it's a massive tax bill you can save, right? However, the timing, you must make that contribution in the same financial year. So if you sold the property April 1st, you've got till June 30, you've got a few months to make that contribution. Even if potentially you don't have the money from the sale of the property yet, too bad, you have to make that contribution. You can't really, do it the following year. The same way then if you, sold the property, say July 2nd, well, you've got pretty much 12 months to make that contribution. So you've got lots of time to plan. Even with your client scenario about, doing 120K today and then another 360 in July, it's really about the timing. In Australia, our financial year is July 1st to June 30. And this is where the planning becomes really, really important because there's potential to save thousands of dollars or tens of thousands of dollars in tax or get a lot more money into a tax-free environment, with the timing of the strategy that you're implementing.
That's right. And we're sort of in that window now, and I'm sure we'll probably talk about this a little bit in property, but when it comes time for property, your standard settlement time is 6 to 8 weeks, right? So you purchase a property, your contract date is effectively the date the ATO sees that you've sold the property. It may now settle in the new financial year. So these are just sort of things where you're saying, right, well, I actually need access to capital to claim that tax deduction. So yeah, good planning comes from this as well.
So important. And the ATO does not grant extensions. Let's just be very clear. They do not care that you have a tax bill. Guys, we touched on some really good sort of broad case studies there. Let's just, zoom in on, maybe a few simple scenarios. We'll dive into the expat stuff a little bit later. One common one that we see, somebody who's self-employed, usually no super, never thought about it, usually until they're in their 50s. And then it's, oh my goodness, I have no money. What do we do? Because it's all gone into the business over these years. So just walk us through, if somebody is starting their own business, already running their own business, maybe it's a family business, how should they think about their superannuation? And should it really be any different to somebody who's a normal PAYG employee?
Well, I'll put it this way, Jared. I've had dozens, I'd argue almost hundreds of people in their mid to late 50s who have said, oh, that's how super works? Well, that's what you can do with your super. It can be tax-free. Those shocking moments where people have the education and go, oh my God, I didn't realize that's what you could do with it. So superannuation, as Joel touched on, is for your retirement. And once you're eligible to, you can put your money into a completely tax-free environment. So no tax on any gains that are made, no tax on any income, no tax on any payments you get out or lump sums that you take out. There's not very many things in Australia that you can do that with. So in terms of someone who's a PAYG employee where they're getting super contributions go in, on their behalf, or someone who's, starting their own business or a sole trader, I would heavily emphasize them to review their super and potentially make contributions, because it can be tax effective for you now and very tax effective for you later in life.
Absolutely. And there's also like other types of contributions as well for small businesses, like the CGT rollover concessions. These can be, if you're sort of entering this sort of next generation or sort of the pre-retirement stage and you've worked for yourself for a very long time, I don't think superannuation should be treated any differently to someone that is PAYG. It is essentially your own money at the end of the day. And the only difference that we sort of control is, the ATO controls the high level stuff, how much you can put in, what the contributions, what the tax rates are in that. But ultimately, when you get to retirement, this could be used as a very tax effective, wealth or income tool for you. It's just a matter of maximizing your contributions in order to make that commercially viable at the end. And working with, your financial advisor and accountant, particularly if you're looking to transition out of the small business, you might have small business, capital gains implications, or, this is where this comes in, where you use, your carry forward concessionals, your CGT rollovers. There is definitely areas there which are very fitted for small businesses, and that's where superannuation can be the next phase.
I think it's important to note as well too that so the maximum you can have in that tax-free environment from July will be $2 million per person. But you can't go and put $2 million into your super today because of these contribution cap limits and the rules you have to follow. You have to do it over time. So if you're going to sell a business this year, you should have been thinking about super 10 years ago. So when you do sell the business, great. Now we've got that $2 million there, all completely tax-free. Because of the limitations of putting money in, you really need to plan early for this.
I guess let's change tack a little bit from somebody who's self-employed to somebody who, maybe 20s, 30s, not necessarily first job, but starting to see their income increase. We all hear this time and time again. I'll think about superannuation later. I can't touch it forever. The government might steal it. Some other nonsense they read online. How should somebody, think about salary sacrificing, getting more into super at these sort of, younger years in their career?
Yeah, I think and this comes down to the benefit of compound earnings, right? So, I believe that we should all be taking a proactive approach to our retirement savings, and the benefit of adding really small amounts over a very long time can yield very powerful results versus getting to sort of your like mid to late 50s and saying, oh crap, I need to come up with a very large sums of capital to start dumping in for retirement savings. Essentially treated as a long burn. Myself personally, I've forever salary sacrificed, and that is where you forego just a small portion of your gross or your gross salary to be directed towards superannuation, and then that tax benefit is realized in your net pay. So, if you're in top marginal tax, for example, and you salary sacrifice $100, well, that's only going to really make a difference to your net pay of the tax benefit that you're saving. So it's not going to be $100 that's going to be coming out of your pay. It's going to be the $52 or something. So overall, there is that saving there. So I have this belief that it should be something that Australians, I think, need to be better and more educated about. I've seen time and time again these ads on TV and, on TikTok. I feel like I'm just bombarded with them at the moment. But they're like, I'm 46 and I have 110,000 in my super. And, you know, a lot of these are like, okay, well, that's fine. At least you've got some. But, you know, there's plenty of opportunity to turn that round and have a very productive retirement strategy through things like salary sacrifice, and taking a little bit of onus in your retirement income.
And I just want to exemplify that with an example too. I'll just quickly look this up. So let's say you're 30 years old and you have $50,000 in your super and you make $100,000 a year. So 12 grand a year is going in from your employer. You're not putting anything else in. By the time you're 60 at an 8% return, you'd have just over 2 million in your account. Or if you decided to salary sacrifice, let's say $1,000 a month. And as Joel touched on, it's a full amount depending on the taxes and whatnot. That $2 million becomes 3.5 by age 60. So you sacrificing that $1,000 a month out of your pay now, it calculates to $1.5 million worth of difference by the time you retire. Like a massive, massive amount. People don't understand that impact of compounding. Like the sooner you start, the sooner you're getting this benefit. I mean, Albert Einstein said the best, compound interest is the eighth wonder of the world. So as soon as you have it on your side and you have it working for you, it's to the tune of potentially millions of dollars you're better off.
And in addition to that, you know, I think for us, when as financial advisors, we're constantly doing things like, you know, retirement income calculations. And when you're saying, right, well, ultimately, the biggest question that I have when I'm doing retirement planning for clients is, how much money can I spend? And, you know, let's just put it into easy maths. You can spend a lot more with 3.5 million than 2, right?
Amen.
So ultimately the goal there is, if you want to continue to enjoy life and, you know, go on nice holidays and have really nice retirement life, you know what to do. I don't think we need to say that anymore.
Yeah. Or alternatively, you spend the same amount, but you can go and buy a $1.5 million Bugatti or something like that to show off.
Yeah.
Definitely not financial advice. I mean, that is such an important one. And I mean, just to, you know, to put some numbers around that, you know, that is a huge difference. But if you look at that, you know, as an annual income, we use the 4% rule, you know, as a general sort of drawdown. How much of your retirement pot can you safely draw down each year without outliving your money? Now on 2 mil, that's 80 grand. On 3.5, it's 140. Now imagine if that was each of you, i.e. a couple, each salary sacrificing at, you know, in Will's example, you know, extra $1,000 a month, which you're probably not going to miss in those early years, to then each have 3.5 and spend $280,000 a year when you're retired. Yeah, we're well and truly into that comfortable lifestyle. So guys, look, I think that's really helpful. We've touched on a lot there. I think some really good examples, whether you're starting out in the workforce, looking at salary sacrificing, you're trying to play a bit of catch up with bring forwards and carry forwards, getting in those lump sum contributions, using end of financial year, using the beginning of the new financial year. Then, of course, the sort of catch-up concessionals, how you can offset some tax on realised gains on property. I think it's a huge one. And, of course, understanding that it needs to be in the same financial year. I've said this multiple times already. I'll say it once more. The ATO does not grant forgiveness. There are no extensions. If you miss the deadline, you cannot catch up. That's it. Lost the opportunity, gone. Try again next time. So don't ignore the fact that we've got a bit of time left. And of course, please don't leave it until the last minute. So look, we might wrap up the superannuation section there. I think that's hopefully hugely helpful for everyone listening, but certainly a lot that people can take away. Let's change gears and move into family trusts, other structures, working with Australians all over the world. We see all sorts of weird, wonderful, and everything in between. We'll try and focus on those that are potentially a little more value add, or at least common questions that we face with our clients. Let's start with family trust. I mean, let's start with perhaps the basics, what they are, how the sort of distributions work, and then let's maybe dive into when somebody might want to consider setting up a trust.
It's a common question that we get asked, Jared. You know, oh, my friend's got a family trust, should I have one as well? And you know, it's not a one size fits all. There are circumstances where it makes sense, and there's definitely circumstances where, you know, the juice is definitely not worth the squeeze, because trusts, you know, they cost time, money, and effort to set up, and they cost time, money, and effort to manage. So you just want to make sure that, you know, you're getting that benefit from them. But when we look at certain structures, there's lots of different options. So superannuation is a structure, you know, in its entirety. So a trust is simply just a structure that we can set up, and that structure can hold assets. Simple as that. So you've got 10 shares in Amazon. You could hold them in your personal name. You could hold them in your family trust. So the trust becomes its own entity that holds on to that asset. Now, why is that important and why is it useful? Primarily, there's two main reasons. Firstly, asset protection. As it is a separate entity to yourself, there is a level of asset protection there, which can help with, you know, blended families is a common area where people will use family trust for that issue. The other big one, which I'm most favorable of, is tax management. With something like a discretionary family trust, you can distribute the income or the gains that are earned within that entity to separate beneficiaries. So let's say me, Jared, and Joel are all beneficiaries of a family trust, and the trust made $100,000 for the year. Generally, the trust can't hold on to that income. It has to distribute it to a beneficiary. So us as the three beneficiaries, we then have discretion of where that money goes. So maybe Joel's had a great year with work. He's making $1 million. Okay, well, let's probably not give anything to him because he's already in the top marginal tax rate. Maybe Jared and myself didn't work at all this year, so we're both starting at zero. Well, we would then most likely distribute, say, $50,000 each to us. Therefore, we're getting the lower tax brackets attributed to our names and saving, you know, thousands of dollars in tax, potentially tens of thousands if we were to just distribute that straight to Joel. So a family trust can be really, really powerful, but you need to ask the question, is it right for me? Do I need the A, asset protection, or B, the distribution of income? And is that worth the cost, the time, the effort to set that up and to manage that long term?
That's right. And I suppose the big considerations, you know, for family trusts, you know, the ATO has basically closed a lot of tax loopholes that, you know, originally they used to have. So nowadays they're not that any sort of big tax advantages are gone, apart from that, you know, discretion of distribution. So it's really important that as we lead up to, I suppose, 30 June, end of financial year, you know, for those that have a family trust, you know, now's sort of the time to have a sort of look at the trust, have a look at the income that's been generated in the trust for the last year. Who are the beneficiaries? It might be, you know, always a good timely reminder to sort of review the trust deed and review the beneficiaries and say, right, who's going to get those, who's going to get the distributions for tax purposes, and ensuring that we're not going to create unnecessary tax burdens for beneficiaries by poor planning.
Yeah. And a big call out there too, just a few years ago, you could, you know, in my scenario, I was there with distributing the money to Jared and I, you could put that on paper and that would be the end of it. The ATO are cracking down very heavily on the distributions not actually going to that person. So in that scenario, if the $50,000 didn't hit my bank account and Jared's bank account and we get audited, there can be some penalties for effectively trying to evade tax in that sense. So if you are distributing money to beneficiaries in a certain way, just note the ATO, it's something that's been on their hit list for the last 2 or 3 years, really checking that those distributions are going to that person.
And rightly so. And guys, you touched on a really interesting point. Your distribution of gains, distribution of income generally has to be done by the trust. But losses are obviously a little bit different. And we come across clients all the time, especially in you know, sort of expat land where they've had a family trust and lost the money. Bad investment, costs, whatever it may have been, there's a loss that exists within that trust. So could you just walk us through, you know, how that might be beneficial perhaps to have that loss and how someone might actually utilize it going forward?
I think the key thing to note is that the loss is trapped in the trust. So whereas income gets distributed out of the trust, the loss effectively stays in the trust to offset, you know, future income and gains. So it's really, really important when you're planning that if you've made a loss, let's say you bought a property for $1 million, sold it for $900,000 a few years later. that $100,000 loss that was made within the trust has to stay there. However, though, that doesn't mean that you still can't use it for future years. So potentially your future investing, maybe the next property or the next share portfolio, whatever you're going to do, should be owned by that trust. So then you can offset those future gains that you're making in future years. Too often we see people make a loss in a trust and then they just wrap the trust up. The investment didn't do any well. I'm going to close that trust up. Well, on a 47% tax rate, $100,000 loss is worth $47,000 to you. So wrapping that trust up potentially just cost yourself $47,000. So it's really, really important to make sure that you think, what's my future planning and what are the options I've got? And could I potentially still use that trust, for future investing or any other purpose?
And then I suppose as well, there's other considerations where, there can be some clever accounting that can be done, right? So if you're going to have or incur significant gains in the trust, is there any other assets, for example, in the trust that are currently at a loss? Is it also worth disposing them at the same time to mitigate that gain? So these are just, I suppose, considerations that make that flexibility of income distribution in trusts a little bit more easier compared to assets elsewhere.
Makes a lot of sense. And I think, really important one to actually look through that trust and work out if there is a loss that's worth holding on to. It might cost you $1,000, $2,000, $3,000 perhaps to run that trust each year, meet all your compliance requirements, filing, audits, ASIC fees, etc. So if that loss is $1,000, well, chances are you should probably wind it up, kiss it goodbye, treat it as a life experience. But as Will said, if it's $100,000 sitting there, potentially worth $47,000 at today's top marginal tax rate, might be worth hanging on to. So definitely have a look at your numbers there with the family trust, and don't simply go winding them up. Now, I guess one of the other common structures that we see both in Australia and outside of Australia are insurance bonds, insurance-linked policies, life assurance bonds. They go by many, many different names. But could you just talk through, I guess, broadly speaking, what they are, who they might benefit, and perhaps who should be thinking about them?
So a life insurance bond is essential, or an investment bond is an investment structure, right, that owns assets. Now, it is governed by the Life Insurance Act rather than the Standard Investment Act, Personal Income Act, Trust Act, various other investment vehicles. Where that happens, you can also have a life insurance bond owned by the family trust. And what happens is if there's any income that's distributed within that bond, to an extent, that doesn't need to be distributed from the family trust itself because it's its own sort of internal governing entity. And one of the really big advantages of a life insurance bond or an investment bond, whether it's owned by yourself or inside a family trust, is the tax benefits of it. Now, if you make contributions to it and buy assets inside the bond, providing you don't breach contributions of 125% of the prior year's contributions, once you hit 10 years in Australia, you can start to withdraw those gains, those income distributions, and they're tax exempt. So this can be a very important part of planning and that overall tax planning, particularly if you're on really high personal income tax brackets. So life insurance is in Australia, it's a company structure. So those profits are capped, or those income is capped at 30% tax. So that could be essentially up to a 17% tax arbitrage event, and can be a really, I suppose, excellent supporting vehicle to something like superannuation if you're up, particularly in the upper echelons of high super balances. So these are definitely can be very positive for some people. Again, maybe not for others. It just really depends on the overall situation there.
I think the benefit, though, as you touched on, potential to save 17% tax on the earnings inside the bonds for a while. And then after 10 years, you can take it out completely tax exempt. So you're effectively negating the capital gains that have been made there as well. So they can be really powerful tax managing structures. And I feel they're massively underutilized. I think Joel, I'm sure you're the same. And Jared, we sit across from, dozens and dozens of clients, and the amount of times we say, oh, have you heard of an insurance bond or an education bond or investment bond? All those names are synonymous. And so many people go, no, never heard of them. What are they? A lot of people don't even know they exist. But I think one of the other key differentials that it's always important to make with these is names in finance always interlock and interlap, and they don't mean the same thing. So, you can have a balanced fund over here and a balanced fund over there, but they're two completely different types of investments taking on completely different, risk approaches. It's just similar with the bond. You have an asset, which is a bond, like a government bond, a treasury bond, or anything like that, which is a physical asset that, you're purchasing. Whereas these insurance bonds or investment bonds are more like a trust. They could be considered a structure that can hold the assets. So, for instance, you could hold a high growth portfolio inside the structure of the bond. I think that's a common bit of misconfusion. A lot of people see the word insurance bond or investment bond and think they're buying some type of government bond or something from an insurance company, where it's not that at all. It's completely different.
Yeah, very important point. And I think one of the other sort of key considerations with that structure, and Joel, you touched on it beautifully, is they're sort of supportive or supplementary income to superannuation. See, the other beauty with the insurance bond is that there is no contribution limit in year one. Obviously, once you're in year two, the 125% comes in. But you might have sold company stock, you might have been running your own business, whether you're an expat or an Australian resident, have $2, $3, $5, $10 million. Naturally, we can't get that all into superannuation very quickly, or in some cases, realistically at all. There just isn't enough time. So a structure like this might be a worthwhile consideration. But yes, as has been said, it is absolutely not a one-size-fits-all. There are many variants of insurance bonds out there that all go by different names. So, of course, always important, do your homework, do your research, and make sure it's actually right for you in terms of what you're looking to achieve. Look, we might wrap up the trust and structures section there. I think there's a lot for people to think about. There are all sorts of other weird and wonderful structures that we do come across from time to time, but we'll keep it relatively simple today. Family trusts, insurance bonds, and of course, companies on the back of that, which we've kind of touched on a little there as well. Let's dive into Australian expats. Now, between the three of us, we've worked with clients in many, many countries all over the world, low tax, high tax, and everything in between, capital gains, income tax. The common thread across the majority are they are Australian. Australian assets or aspirations to retire to Australia, or at least have some sort of connection. And I think, Australians working in Australia have a hard enough time keeping on top of super and tax and all the other rules. Australian expats really just have no chance. And we come across it time and time again. Don't know where my super is, never heard of MyGov, don't know how to log in, goes to an old Australian number. We've heard all the excuses, and some of them a little more legitimate than the others. But let's dive into what expats need to be thinking about come the end of the Australian financial year. So maybe let's dive into superannuation. Let's start with the basics. So what do expats need to think about or review as to whether they should put money into that Australian superannuation?
Yeah, and I suppose that's going to come down to, a number of factors. And, there's definitely no one-size-fits-all approach here. If you're someone that is, 55 and you're thinking of returning to Australia to retire in the next sort of 5 years, then superannuation is going to be a very sensible vehicle. And because of those contribution limits that we were talking about earlier, then naturally that's going to make sense. There's no rules that say a non-resident of Australia can't contribute to super. Now, where you've got concessional or non-concessional contributions, this is going to be governed by whether you're incurring a tax liability in Australia. So we've got taxable Australian property. So if you have, for example, an investment property that is positively geared, so essentially meaning the rent that you're receiving is more than the expenses of the property for that year, then that means it is positive. So you have to pay tax on that positive amount, and non-resident income tax starts at 30%. So, by making, for example, a concessional contribution to superannuation, that goes into superannuation and you pay 15% tax on entry for that, but you claim a tax deduction on that non-resident income tax. So 15% tax is a little bit better than gifting the ATO 30. So, with proper planning, you've negated you're saving yourself 15% tax. So these are things that, even expats living all over the world, just consider your overall situation at the moment, both in the country that you live in and in Australia, to see what your overall tax position is and what your overall goals are, and ultimately where is going to be the end goal.
I think it's so interesting, Joel. You touch on how it's such a case by case basis. Like in your scenario with a 55-year-old, super's probably going to be at the top of the priority list. It probably makes sense there the most, but you could have the same position. So let's say someone made $10,000 of positive rental income. The ATO is going to take 30% of that as a non-resident, so $3,000. Let's say this person has 10 grand in their bank, but they're only 30 years old. So they could put that 10 grand in their super and they'd save $1,500 taxed in doing so. But now they're effectively locking that money away until age 60. So maybe they've got other goals that, the following year they wanted to take 6 months off and travel Europe, or they wanted to buy a family home in 5 years, or something else that potentially is more important than saving that $1,500 of tax. So it's funny because it's not always rational. Straight away you think, of course I'd want to save $1,500 in tax where I can. But then when you start to factor in, the ups and downs of life and what makes us happy and what motivates us and all the other goals that we have, well, potentially that's not the best thing for you to do, because it, reduces or diminishes these other things that you're trying to work towards. So it really is a case by case basis. The other thing I just touch on that I think is very important, regardless of whether it's end of financial year or not, is look at how your super's doing, look at how it's invested. Too often we see expats that haven't looked at their super for 10 years or 20 years or 30 years, and, they've been getting an average of a 4% or a 5% return a year, when the industry standards are getting 7, 8, 9, 10. So that, again, is costing you hundreds of thousands of dollars in the long run by not getting that performance that you should be. Too often we see people just in the default fund, that their supers, allocated them to, and then that's how it stays for decades. So the other key thing I'd say, it's always a good time to do it at the end of financial year. You can do it at any point in time. Look how your money's invested and make sure it's getting you to where you want to be for that longer term goal.
Very well highlighted, Will. And mate, I think if you can show me how to take time off and travel Europe for 6 months on 10 grand, you can be my financial advisor. That sounds pretty good.
Backpackers budget.
Oh no, sorry, can't do that. Doesn't mean you can't do it. Guys, we've touched a bit on property, and we'll dive into a little bit of specifics around property in the next section. But just touching on property for a moment for expats, there's a few really important things to be aware of. And I just want to highlight, I guess, a bit of a case study as it relates to superannuation. We have two forms of property, or two forms of tax on property for expats. We have main residence and we have the investment property. Main residence is the one you lived in before, and investment property is the one you didn't, in simple terms. Now, as many on the call and the community will be aware, the main residence exemption, which allows you to live in a property, leave it, rent it out for 6 years, and not incur capital gains tax for that period, was removed for expats in 2019. Not only was it removed, but if a non-resident, so Australian expats like myself, sold that property, we would not only pay tax from the date we rented it out, but from the original purchase price, which is ridiculous, but we're not going to get into that on this podcast. And then, of course, we have investment properties, and the tax applies at our non-resident rates. Now, the reason I want to highlight this is because Joey touched on this really well earlier in superannuation, around this 162,500, we can get into super. So can you just step us through a bit of a case study of when an expat selling a property, usually going to be where, a large substantial gain might exist, and how they could use super to offset some of that?
Absolutely. So there's a couple of things that you can do there. If this is a property that you previously lived in, great. And let's just say hypothetically, you're also over the age of 55. You've got the downsizer rule, which was reduced from, originally it was 65 and then it went 60 and now it's 55. But so that could be up to 300,000 as a contribution. If the only sort of rule around being eligible for the downsizer contribution is that you must have owned it for 10 years and it has to have some form of CGT exemption. So really important if you're an expat, if you're not getting a CGT exemption, then it's unlikely that you will get, you'll meet that eligibility. So if you become a resident again as a resident, you are then acknowledged that CGT exemption. So you could then make up to $300,000 into your super, which is exempt from all of the other caps. And when you retire, then that's $300,000 that's now in a tax-free environment. The other thing with Jared was saying was back to the concessional carry forward. If you've lived overseas for more than 6 years, in that case, and now you're returning to Australia, you're looking to retire, you're going to offload the investment properties, there's likely that there's going to be some capital gains payable just because of the timing. It's been an investment property for many years. There's going to be tax payable on the sale of that property. This is where, for example, you could make, in supplement to these other contributions, the concessional carry forward. You could use, if you've made no concessional contributions for the previous 5 years, including this current year, we could add 162,500 and claim a tax deduction. Now, if you've got a capital gain of, say, 500,000, that means that tax is then only calculated less that 162,500. So that could be a very significant tax saving and as Will mentioned earlier, upwards of 50 something $1,000 in tax savings in top marginal tax rate territory. So, that's a significant difference that you can make. And by all means, I'm pretty sure no one is going to be debating or refuting the idea that money's worth more in my pocket than the ATO's.
Absolutely. As Mr. Kerry Packer, or the late Kerry Packer, stated, I think we can all agree that we can spend it much better than the ATO. So why should we voluntarily give them any more than we absolutely need to? Look, I think that's a really good one and a really important one for people to be aware of. The other point of clarification that I just want to make while we are on the topic of property and expats is this, because we hear this time and time again, and I know all three of us have heard this from Australians all over the world. Usually they've either heard it online or been told it by someone in our industry who really shouldn't be delving into areas that they're not, really specialists in, is this whole idea that you could have bought an investment property in Australia, let's say 10 years ago, while you lived and worked in Singapore or Hong Kong or UK, wherever it may be, and then you can just go move back into it, sorry, not back, but move into the property, and all of a sudden, those 10 years would be exempt from capital gains. Wouldn't that be lovely? That is not how it works. We cannot go back in time. So in that instance, you could only eliminate future capital gains from the point you moved in. So don't think you're just going to be able to go back, move in for a week, sell that place, and get all that money out tax-free. We do need to give that some proper planning, some proper thought, and look at how we can offset that with legitimate strategies. Look, I think that gives plenty for people to think about. Expats, residents alike, we've got still a bit of time this financial year, so it's a good checklist. Look at whether you've got taxable Australian property, review your rental income, ask your property manager for a summary, The majority of banks these days will allow you to look at your financial year summary to outline how much interest you've already paid. And of course, you can then adjust offset balances or any other changes that you may need to make. Let's go into, I guess, just a couple of questions on the property side, because I think we've touched on a lot of this already across the different areas. But obviously, it's end of financial year. Property investors, I know one thing we haven't touched on just yet, depreciation, and then, of course, any repairs or maintenance that people might want to look at. Let's start with depreciation. What is it? How does it work? How can it benefit us tax-wise come end of financial year?
Depreciation effectively is the value of the asset going down over time. So I think the easiest place to notice that is a car. You go and buy a Lamborghini today, and it's not going to be worth as much as it was today in 10 years' time. It depreciates. It goes down in value. So when you have a home, an investment property, generally, depending on how new and how relevant that property is, you can depreciate the value of the actual asset itself. So, the fittings, the fixtures, everything like that. The key thing you want to do is have a depreciation schedule. So you'll have someone come in, they'll look at the property, they'll tell you what you can depreciate every single year over a period of time. The most important reason you want to be doing this is because that's all tax deductible. And as we've touched on about 3 dozen times in this call, don't pay more tax than you have to. And that's a great way to reduce those taxes. Now, the other key thing to call out is for any other, maintenance costs or any cost that you incur with your property, the ATO always, the tax event is on receipt. So if you prepay interest, for instance, or you have, as Joel said, you've sold a property this year and you've got a $500,000 gain, well, maybe we should do a little bit of work to the other property or something like that now, this financial year. Therefore, that cost or that receipt of that cost is the same financial year, the current financial year, and therefore we can use it to deduct against that income and that gain that we've made. So the timing is really, really important here. But on the depreciation piece, if you've got a more modern property, get a depreciation schedule. It will be worth its money, pretty fast.
Absolutely. And Joel, maybe we'll throw this one over to you. Repairs on property versus upgrades, renovations, how are they treated, and why might we want to think about it before we actually reach June 30?
That's right. So there's two sort of key differences when you have an investment property. And one basically is how the ATO defines what a capital improvement is, or is it a repair? Now, let's just say hypothetically, something breaks in the house. You've got a property, the hot water system goes, we need a new hot water system. That, in the eyes of the ATO, is generally a repair because it's something that works currently, it breaks, it's no longer working, it needs to be replaced. So when you replace that, the cost of that is generally a one-off deduction that you can apply as a straight up. And that will reduce your taxable income for that financial year. When it comes to depreciation or capital works or capital improvements in nature, this could be things like your kitchen has deteriorated over the course of, 10, 20 years of the life. And you need a new kitchen because it's decrepit. That is likely to be viewed as a capital work, as a capital depreciation. So that the life of everything in there will then say, right, this kitchen is expected to last 10, 15 years. We'll depreciate the cost of all the materials and the renovation over the 10, 15 years. In some arguments, and this all comes down to an accountant as well, I've had conversations with accountants that have said, things like paint or carpets can sometimes be considered a repair because it's no longer to the point where it would be satisfactory. But again, it's probably worth getting your own advice on the situation of your individual property regarding whether it's a capital improvement or it's a repair.
Perfect. Makes a lot of sense. And I think one of the other sort of somewhat common questions we get asked, especially by a lot of our sort of to-be Australian expat clients, so they might be living, working in Sydney, Melbourne, Perth, wherever it may be, thinking, hey, we're going to go and, take that job in London or New York, and we're going to rent out our current property. And the question gets asked, what expenses are deductible, and do we have to actually wait until we've left? So as Joel, rightly points out, always speak to your accountant, seek some advice on this one. The general practice is the property should be available for rent when you are incurring these expenses to actually claim them. But of course, seek your own advice and assess what's right for you. But plenty to think about when it comes to property. If your property is negatively geared, positively geared, end of financial year is just around the corner. So certainly plenty that you can be doing. As Will said, it's not always just about tax. Sometimes you might want to travel to Europe. You might want to do a million things. We're traveling to Europe on 10,000, buying a Lamborghini, buying the Bugatti. Some great examples, Will, that are very...
I'm not even a car person. I'm not even a car person. I don't know why I'm saying these examples.
I think that's a natural point as well, Jared. Lots of times as well, we have clients that say, "Oh, I don't need a financial advisor. I've got my accountant." And this is you're sort of starting to point out the very key reason and difference between an accountant and a financial planner. We're not just considering tax as the be all and end all and the outcomes of the scenario, which is what an accountant is trained and designed to do. But we definitely serve completely different functions and look at things a little bit more holistically.
Absolutely, Joel. No, very well pointed out. I think always good to have a very good one of each in your corner. And yes, very rarely should they be the same person. Guys, look, I think that is hugely helpful. We might wrap up our sort of end of financial year special there. We've covered a lot: superannuation, contributions, salary sacrifice, ramping up contributions. We've covered a lot for Australian expats. Quite a bit there around structures, when they might suit, when they might not. And of course, a few tips and pointers for property investors. So hopefully everyone has gotten a lot of value out of that. Hopefully there's a few gems to consider for yourself, what might be right, what you might want to avoid, and what you should at the very least be aware of. So hugely grateful for both of you joining. It's been really helpful. I think great to get some case studies, some insights into the conversations you're having with Australians both back home in Australia and around the world. I think that's going to be really helpful for the community. So on that note, we might wrap up there and tell people a little bit about what happens next on the podcast, how they can find out more, and of course how they can benefit hopefully from our experience and wisdom and a bit of entertainment value going forward.
Well, the podcast, as always, is released on the last Wednesday of each month. Every month we do try to interview an expert in fields ranging from tax to financial advisors like ourselves being the experts today, to estate planning, to moving countries, to real estate agents, you name it. And if you guys have anyone that you want us to interview, please let us know. We do this podcast for you. It's for educational purposes. So if you do have someone you want us to interview or a field you want us to look into, we love hearing from our listeners. So definitely reach out to us, guys, if you want to learn something or have a topic that you want us to deep dive into.
The podcast is available on all major podcast hosting services. So if you find us on any or all of them, please like and subscribe, because the social media world is forever getting bigger and better, and presence is bigger than ever. So just, I suppose, reconfirming, we're available on all socials. We are Money Side Up on Instagram, Facebook, LinkedIn, or X, Twitter. And again, yes, we would love to hear from you. Next month, we have a great speaker lined up, so don't miss out. We'll be talking about immigration options into Australia. So we see this quite a lot. Australian expats meet a partner overseas and then they wanting to move back to Australia. So always a touching matter. So thanks so much for tuning in, and we look forward to seeing you in the next episode.
Until next time, guys.
Thanks, everyone.